So I'm incredibly fortunate today to be chatting to Jim Bianco of Bianco Research. Jim, how are you?
I am fine. I'm in Vail with you, and this has been just a fantastic week here for the conference.
It's beautiful, isn't it?
Yeah.
The one thing I would say is it's kind of dry. I'm finding myself perpetually drinking water and perpetually feeling a little
Well,
thirsty.
when you're at extreme altitude, we're technically in Beaver Creek at 8,100 feet. It is very dry, and you do have to continually hydrate yourself. In everybody's job, there's always things, drudgery and things you like, a drudgery and difficult things, but coming to a conference in Beaver Creek is not one of them.
People have said to me, my glass is 3/4 empty. It's true. I'm perpetually looking at the
Right.
cloud, not the silver lining. But yeah, it is lovely. But I don't have so much time with you, and I really wanted to get into your views. So the first thing, I saw you talking about the question of whether we're in a new cycle. What exactly do you mean by a new cycle?
So I have been operating under the premise that when the global economy shut down and then restarted in the spring of 2020, that was more than an unexpected one-off event, that was the end of a cycle, that the way in a cycle I would define for this conversation as a set of rules at how the economy operates, and that moving forward, we are operating under a new set of rules. In other words, the economy is different. And I like to qualify that by saying, I didn't say dystopian, I didn't say worse, I said different. So the rules that we use, well, when X and Y happen, you should expect Z. Well, that might have worked up until 2020, but it doesn't necessarily work as we move forward. Now, why do I think that? I think coming out of the shutdown restart, if you want, the analogy I've used is we rebooted the software and it didn't come back. It didn't load the same way. Sometimes that's not the worst. But the most high-profile event is remote work. This is a permanent thing. Everybody seems to be going, towards that. The movement towards labor having more of an upper hand against management. We've been seeing that with all of the strikes in the United States, and that. All of this is changed two dynamics. It's changed the labor dynamic, and it's also changed, our lifestyle dynamic. As I like to say, pre-COVID, we were home 2 days a week, Saturday and Sunday. Post-COVID, we've doubled that. I'm home Saturday and Sunday, and like typical worker, I'm home Monday, Friday, and I'm in the office Tuesday through Thursday. If I'm doubled the amount of time I'm at home, when I go to the store, I'm buying different things, I'm doing different activities, and my consumption basket has changed. So it's just a little bit more than I'm just at home more. My consumption basket has changed. Ask the retailers. The retailers are still struggling. What do I put on the shelves? I'm still trying to figure out what people want to buy because their lifestyle changed because of this whole thing. And we need to start to understand how it is in moving forward. So one of the practical applications I've used on this is labor is going to see more wage gains. We're going to see stickier inflation coming because of the increases in costs because of labor. And that the old rules that we're going to go back to the slow, steady labor market that we saw before, it's not going to come back. We're not going to go back to the office 5 days a week. That as an example. So we need to start to understand that we're in this new cycle.
So is that why you talk about no landing as opposed to a soft landing?
Right. So no landing is, I got to give credit to Torsten Slok at Apollo. He's the guy who came up with the term. We talk about hard landing, which means a recession. And then we've got no landing. And I might joke to you, that it's the ultimate Wall Street forecast, no landing, because it's kind of in the middle, which is what Wall Street loves to be all the time.
Soft landing, yeah.
Right, a soft landing is kind of in the middle, and it has really no definition. Some people think it's below trend growth, some people think it's a mild recession, so I can never be wrong because it doesn't quite have a hard definition to it. And so to stick with the airplane metaphor, there's a no landing. So we've got hard landing, which is a crash, which is a recession, a soft landing, which is kind of in the middle, and then a no landing is the plane just keeps flying. That means we just keep churning out positive quarters of GDP. The no landing scenario, what I'm arguing is what has happened 85% of the time throughout history. 85% of the years in the last 100, we have positive growth. 15% of the time we have a recession. So that's all the no landing is. And so when I say I'm in the no landing camp, what I mean is we are going to get a positive third quarter GDP growth. I think we're going to get a positive fourth quarter GDP growth, and I think we're going to get a positive first quarter. So no recession. We're not going to flirt with zero. At least I don't see it yet. Now, why do I think that? Because I think that the wage growth, the nominal growth, the stickier inflation is going to keep these numbers afloat. No landing as we move forward, and that's going to keep the heat on inflation up. So that's all I mean by no landing.
So these things are qualitative rather than quantitative. It's like a hard landing. Hard landing I can kind of define. Soft landing doesn't really have a hard definition. No landing doesn't really have a hard definition.
Yeah,
either.
exactly.
I think a lot of it, something I've recently started asking myself is whether I should think of the Fed as hawkish. Is the Fed hawkish? Because if they decide that, we've decided to stop hiking, but growth is still chugging along just fine, that's not what I call hawkish.
Right. So this is I have a very heterodox view, a fancy word for saying outside the box, that everybody, if you ask the consensus view on Wall Street, the Fed's raised rates 500 basis points, and the 10-year yield has gone up, as we're talking now, over 4.6%. That's a huge eye-popping kind of move. That has to have some kind of implications. Well, the yield curve inverted, so Wall Street has been unusually pessimistic on the economy, calling for a recession in 2 quarters. Now, they've been saying that for a year, and they're still saying that in 2 quarters we'll have a recession. Never seems to ever arrive. And therefore, they're all bullish on bonds because by duration, because once that recession hits and the Fed has to pivot and start cutting rates, we will have a big rally in bonds. Now, as of we're recording, that has been pretty much the argument all year, and pretty much all year has not worked that way at all.
Bonds are getting crushed right now. We're talking on September the 28th.
Right.
And it's just been one ratcheting higher and higher and higher in yields all through the last couple of weeks.
Because I think to my heterodox view, that 500 basis point rise in rates, I think that most of it has been following what is the new neutral rate higher. Because of higher inflation, the no landing meaning growth. And if we're in a new cycle with more labor, then we're in a cycle where you would have to have bigger premiums in the market to anticipate upside surprises on inflation. So in other words, term premiums widen out, real rates are going to stay much wider than we think. And I'll give you an example on real rates. Real rates, which is the yield in the 10-year less the inflation rate. It's about 2% on TIPS, Treasury Inflation Protected Security Yields. And Wall Street's freaking out. Oh, it's the highest since 2009. Well, yes, it is the highest since 2009. It's a 14-year high, so therefore it's too high. Well, what about the history of TIPS to go back to 99? Well, the average real yield is 1.3%. Okay, so we're a little bit above that. Well, that's only because they started in 1999. What if we used actual real yields and went back 50 years? The average is 2%, and we're at 2%. Well, if we went back 200 years, which I actually did, the average is 4%, and we're at 2%. My point is, real yields, when you get into these inflationary concerning environments where this new cycle that I'm arguing is, they should be around 2 or 3%. And that's where they are now. So really what I'm trying to argue is this big rise in rates has largely followed neutral. So has the Fed been unusually hawkish? And does the Fed have to cut 75, 100, 125 basis points next year because they're putting so much heat on the market by being overly restrictive? Maybe not. Maybe really they're just slightly restrictive, and that really the neutral rate is not that much farther below us. Again, it's a new cycle. A lot of old cycle thinking is, well, of course, we're going to go back to zero on the next downturn and interest rates. No, that was the old cycle. I think in the new cycle, if we had a recession, we go back to 3 on interest rates. We don't go back to 0 until we get past what I call this inflationary period.
Forgive me, I'm really enthusiastic on this theme. It gets me very excited because I'm a very weird guy, but also because I think it's obvious the Fed is not really that hawkish because they talk about higher for longer. And a lot of the work is meant to be done not by pushing rates up to where the Taylor rule would say they should be, but by leaving them at a slightly elevated level. That doesn't seem hawkish to me. That's where you don't want to go too far because you're afraid. You're afraid of the possible consequences. So you're going to leave them a little elevated and say, let's see if that works.
Right.
Well, we had Warren Mosler due to come here, and unfortunately for health reasons, he couldn't make it. But Mosler has a really interesting argument. I don't know if it's right. I think he is right, but I'm often wrong, so I'm not sure. He argues that if you start off, when you have debt to GDP of 100% and move rates 500 basis points, you have created a 500 basis point fiscal stimulus where the government, on a flow of funds basis, the government is shoving 5% of GDP into the economy in the form of coupon payments. Now, it's not a very progressive stimulus because giving bondholders money to spend isn't the most progressive thing. The bondholders are not usually the poorest people in the economy, but it is a stimulus. So Mosler's argument is the Fed thinks it's pressing on a brake. It's actually pressing on the accelerator. Does that strike you as just as too extreme, or what do you think of that?
Well, I'm familiar with the argument, and that is a foundational argument for modern monetary theory, which Mosler has been a big proponent of too. And it is a theory, by the way, that Erdogan in Turkey has definitely fallen into, and he has been promoting this idea that because Turkey has inflation, it's because they have high interest rates, and that all of these interest income are flowing into the economy. That's the money. So we have to cut rates to bring inflation back down. Yeah. Now, I understand the mechanics of the argument, but I think what it's missing is that 500 basis point coupon payment that is flowing through into the economy does not come into the economy uniformly. It's not that all of us are getting a stimmy check for the same amount. When I talk about higher interest rates, and I am talking at an investment conference here, I see a lot of glum faces in the crowd because it's all a bunch of risk asset owners that don't want to see higher interest rates. They don't want to see the competition with stocks of the do-nothing competition of rates going up. Sure. So they see it as a retardant to the economy, and I think they're right. If I gave the same speech to a retirement community in Boca Raton, they would probably stand and cheer at the idea of higher interest rates. So really the question is that the interest payers, that are people that receive interest income are going to benefit. The people that have to pay interest income are going to get hurt. What is that mixture? And I think that when you really cut it through with the economy, it's probably a net negative that interest rates are going up. There are segments of the economy where it's going to benefit. Look, we're all going to benefit from pulling out our phone, transferring our money from our 1 basis point yielding Chase account to our 5.5% yielding Chase money market fund. But then when we've done that, we feel good. Look, honey, I've created all this interest income. Then comes the variable rate mortgage bill. And then that's where the interest income goes right back out the door. And I think when you net it all together, that higher interest rates are a bit of a net negative. But he is correct. And I think Wall Street sometimes, and especially risk asset owners, sometimes think that every tick up in interest rates is a negative. And that no, because there's an offset to it. So you hear a lot of people wringing their hands. Oh, the interest on the debt's going to go to some unsustainable level, and that it's going to crush the U.S. government. Well, yeah, and who are they paying that debt to? They're paying it to the people in Boca Raton, and then they're going to turn around and spend it, and you can tax them on what they've done in their activity to kind of bring it back in. Now, it's not a perfect offset, but it is a cushion to it as well. But that said, I think it's more of a net negative that rates go up, but it's not a pure net negative like some like to say, so that every basis point means just whacking the economy that much more.
So it's a mitigating factor.
Right.
And what people think is a very restrictive monetary policy just ain't that restrictive. And you've made what you've described is the disaggregating, working out who is benefiting and who's losing. And clearly, if you jack up rates, interest rate sensitive sectors will lose. Does that the losses to the interest rate sensitive sectors explain why some people think they're seeing a weak economy while they forget the gains that are accruing to people with large cash balances?
Yes, and I think that that's definitely the case, and especially because of the emotional nature of it. So interest rates go up. What is a big interest-sensitive sector of the economy that suffers from it is housing. And we've seen that the home sales numbers, the day we're recording, they got reported again, the new home sales numbers have plunged yet again. Houses are not trading, and they're not trading for a very simple reason. Most people are locked into a 3% mortgage, and if I sell my house and I buy a new house, I'm going to have to get an 8% mortgage, and I don't want to change my cash flow. So I'm kind of sitting tight right now. I understand that argument. And for most people, a home is their biggest investment. And so if their biggest investment is experiencing an illiquidity problem, then they're going to be concerned. Now we take that to the next level and we say, well, because there's less liquidity, because homes are not turning over, therefore it's bad and it's going to fall down. Well, on the other side of the equation, what's interesting too is if you look at the new home sales, the average home price, those prices are not coming down. In fact, they're starting back up again. So those homes that are selling are being bought by motivated buyers because they need a home and they'll pay up for it. And maybe that's part of the no landing argument because the economy is holding together. And so, I would like to see in my neighborhood, when a neighbor of mine puts a house that's similar to mine on the market, I'd like to see it sell with 5 bids in a day.
Yeah.
Because that gives me comfort that if I put my house on the market, it would sell for 5 bids in a day. But when my neighbor puts his house on the market for a price I'd like to get, and it's still sitting there for 3 or 4 months, it makes me feel a little bit worried, even though I'm not in the market to sell my house. So I get that. So it's very emotional. And then we translate that to the entire economy. But I think that can be a mistake because there are other aspects of the economy, like healthcare, like energy, just to name 2, which seem to be doing very well, that are more than an offset to it.
So this freezing in the real estate market, where existing people who got 3% mortgages, and that includes me, and I imagine it includes you too. On the one hand, great, we are insulated. I read a number that said that only 9% of US mortgages have rates above 6%. So you can see that part of the US mortgage market is not very interest rate sensitive. Those home buyers aren't very sensitive.
I mean, most of those are new mortgages, and that number is going to go up as everybody takes out a new mortgage.
It will tick up over time. It will tick up steadily over time, but slowly. The other side of this, though, is you've just made the US economy incredibly immobile. Like if you said to me, you've got to move, I don't want to sell my house. If I sell my house, I lose my mortgage. I've got a 3% mortgage. Why would I sell that?
Right.
So all of a sudden, nobody wants to move. And this is the longer this persists, the more damage it does, longer term damage it does to the economy.
But by the way, there is just to go off on I'll go off on a quick tangent. Sure. There's a fix to this. It's called an assignable mortgage. And an assignable mortgage means you have a home with a 3% mortgage. You could sell your mortgage with your house, and the buyer would pay a premium because they would also be getting a low
funding.
They're going to be buying your future cash flow payment as well. And then that extra premium that you get, you could apply to your new 6% mortgage that would effectively bring it down to a 3% mortgage. But we'd need legislation to change that to become assignable mortgages.
It'd be a big transfer to homeowners from mortgage bondholders.
Right.
Relying on that duration tick down.
Right.
As people are forced to move, you die, whatever.
Right.
Those mortgages do expire, even if they're deep in the money, so they shouldn't go. So there's that. The other thing is, you push rates up, and interest rate sensitive sectors hurt. The stories we're all hearing about a real estate market in CRE, office sector, and even multifamily residential. It seems to me where I am in New England, cap rates are about 6.5%, and funding rates are maybe 7.5%. Someone's just lost a load of money. They just don't know it yet. A bit like the Sixth Sense,
Yes.
I see dead people, they just don't know it yet.
Yeah.
Doesn't that matter?
Yeah, it does matter. It matters, it especially matters, for the financial sector, which is why regional banks, 70% of all CRE loans are written by a regional bank, and they usually hold a lot of those on their balance sheet. So that's why the regional banks are suffering. We keep thinking it's because they're going to fail. No, it's because their profitability is at risk. So I think that those stocks are down so much. So your money in a regional bank is safe. You're not going to lose your money if you own the stock and you're expecting them to send you a dividend. That might be a different story. But I think, yes, there is that issue, but that's not necessarily an interest rate problem. I think what's happened with multi-residential and office comes back to the new cycle. Work from home, remote work. If that is indeed the case, this is why office real estate is struggling. Now, the problem there has been for 3 years, as we've seen work from home, we first of all, the Kubler-Ross five steps, we first mocked it, get out of your pajamas and get back to the office, and then we fought it, and then we bargained with it, and then we went through depression, and now we're finally into the acceptance part of that. But that has nothing to do with interest rates. The multi-residential, that's the lifestyle change. If I only have to go to the office 2 or 3 days a week, maybe I don't necessarily have to live 10 minutes away in an apartment that I didn't really want to live in. I could move further out or move to another state and change my lifestyle. And we're seeing a lot of that happening as well too. One of the conference goers here moved up here during COVID and never left, and it still is very vibrant in the Wall Street community from Vail, Colorado. So that's just one example of that. So yeah, I think that this is part of the transition that we're going through. This would have happened even if we were at 3% rates. So I don't think you necessarily want to pin this the office market is in trouble, the residential real estate or multifamily real estate market might be in trouble. This is a lifestyle change, and this is a working preference change, and that 0 rates wouldn't have stopped it, and 6% rates, it might be accelerating it, but we were going to do this anyway.
So I'm sure that's right, but it doesn't help. If you've got 70% vacancy, that's hurting you as if you're a multifamily residential real estate owner. You've got 70% vacancy and you've got 7% rates, then your principal...
It doesn't help, but if you turn to the person with 70% vacancy and said, okay, here's a 3%, I'll cut your rate to 3%, it's not going to fix their problem. It's going to make it a little bit, better on the edges. So let's remember what the major problem is. It's a cycle shift in preferences and in the way that we view things that is really driving this. Not that everything was fine and that we just piled on interest rates. And by the way, on that subject, Wall Street, as I said, this is a heterodox view that I have, that we're going to have no landing with this new cycle. You hear phrases from Wall Street all the time, normalization. Powell at his press conference last week used the word rebalance 3 times. These are code words for that thing that happened in 2020 when we laid off 14 million people and then called them all back to the office and was just a temporary thing. And that we're all going to wind up going right back to the rules of 2019, rebalance, normalize. And this is really, to me, is the bigger issue. Is that right? Every time you use the word rebalance, I want to say, stop, your whole analysis is wrong. Because you're assuming we're going back to the cycle of 2019. You're assuming that we're still in a 2% inflation world. You're assuming we're still in a 5-day office workday world. You're assuming that we're still in a neutral interest rate world of somewhere around 2%, if not lower. If we're not, and that 2020 marked a cycle change. And by the way, when I say change, what I really mean is we accelerated cycles. Yeah. This whole work from home thing was happening. It's just we leaped ahead 20 or 30 years.
I know, it's beautiful proof of concept. Once you prove it, you have to ask, why am I here when I could be there?
Right.
And then you get this accelerated acceptance of the concept, and we all have to change.
Right.
Past a tipping point.
So when we hear the words normalization and rebalance, that's why I want to say stop right there. Whatever you forecast next, it doesn't matter. How do we know that why are you so sure we're going to go back to these old rules?
Yeah.
And that if we're not, and we are stuck in a higher, stickier inflation world with labor having more control over management and in demanding higher wages, and and I just don't mean unionized workers. I mean, you probably know as well as I do, people I know that said the boss wanted me back 5 days a week, so I quit. Well, in 2019, if you told me that, I would have sent you to a psychiatrist. In 2023, it's like, yeah, that's what people do now. And that's how much we've changed in 4 years. That's a gigantic change in 4 years as well.
So when I hear the word rebalance, I want to know what's out of balance. I mean, you're right, there's a mean reversion component there.
Mean reversion is the most powerful drug on Wall Street. That I can tell you that there are people that have made successful careers on Wall Street. You say, this stock's up a lot, or this is up a lot. Yeah, well, it's going to come back down. This stock's down a lot. Yeah, we'll buy it because it's going to go back up, because they just think everything mean reverts.
Yeah.
And there are cycles where that works. But mean reversion is one of those strategies that has a high success percentage. If I play mean reversion, I'm right 60-70% of the time.
But when you're wrong,
when you're wrong,
wrong.
yeah, when you're wrong, you get annihilated. Is what happens with it.
So something is out of balance. I can kind of agree with that. I'm not sure something's going to we're going to mean revert. I agree with you. We have these fundamental changes. We're not going to.
So let me give you an example. So is there a historical analogy to what I'm talking about? Yeah. And I think it's World War II. I think it's the 1940s. In September 45, the war ended. If you go back and you look at the statistics, in October 45, we had minus 2 million on the payroll report, which was the largest until the spring of 2020. And what was that? That was the war ended. We didn't need you to make Sherman tanks and P-51s anymore, or M1 rifles, so we laid off 2 million wartime production workers. We celebrated that because we were ready for the war to end, and at that moment in 1945, everybody knew that the economy starting tomorrow morning was going to be very different, and we had to transition to a new economy. And we had some fits and starts through the 40s. We had a bout of inflation. The metrics then went to about 20%. On today's metrics, it'd be about 9%, similar to what we've seen now. We had a recession in 47. We had another recession in like 49, 50, and then we had a boom. That's because we transitioned the economy. This is similar, except the big difference is you've got guys like Dave Solomon, the CEO of Goldman Sachs, and Jamie Dimon, the CEO of JP Morgan, basically arguing nothing has changed, and that we need you to get back in the office 5 days a week, and we need everything to return to normal. So when we look and say, look, things have changed, we need to restructure the economy for this new post-pandemic economy, we've got many voices saying, no, we don't need to restructure it. We need you to get out of your pajamas, go back to the office is what we need. So we're not doing it. We're wasting time. So eventually we'll recognize the new set of rules that we're working on. And I'm not going to pretend to tell you I know what they are. I just know that they're not the 2019 rules.
Yeah.
And so then we could get about restructuring on the economy. Until then, we are going to stay out of balance. A year and a half ago, supply chains had a huge shortage, and we were all obsessing about container shipping rates and that they were through the moon, and we were watching the number of idle ships in San Pedro Bay off of the LA and Long Beach ports. Yeah. And then all that stuff crashed down to huge gluts, and there was no ships that were off in San Pedro Bay, and it went back the other way. And then we said, see, that was just a one-off. Well, that's all bottoming, and it's starting back up again because we haven't quite gotten this cycle into order one more time. Just to stick on the supply chain, as I understand the supply chain, it's very efficient within channels. What do I mean by that? I'm a retailer, and I call up my supplier and they say, red sweaters aren't selling as much. I needed blue sweaters. I have them in 2 days, some blue sweaters. But if I call up my supplier and say, sweaters aren't selling, I need shoes, and I don't want them delivered to LA, I want them delivered to Charleston.
And it's out of season.
Yeah. 2 years. It'd take him 2 years to reorient that part of the supply chain because you're asking to go out of channel. And so the supply chain needs to be a little bit more robust as we understand we're home 4 days a week, not 2 days a week. Our lifestyles have changed, our preferences have changed, and as we understand what that is, we're going to be calling our suppliers and say, I don't need them from China, I need them from Indonesia, and I don't need them in LA, I need them in Long Beach, or LA or Long Beach, I need them in Charleston, and I need this whole new set of stuff, and I need it Thursday. They're like, no, I'll have a proposal on how we're going to do it for you in 3 months, and then it'll take us 15 months to do it. And we need to start thinking about it in those terms, but we're not, because we got people like Diamond and Goldman, my two favorite whipping boys, saying, just shut up and get back in the office, and let's all pretend it's 2019 again.
Usually when I hear Jamie Dimon speak, I ask myself, how does this affect his compensation? And in this particular, I would bet that JP Morgan owns its own office buildings.
Yeah.
Not least. So if this...
No, they built a new office. They built a new $1 billion office tower in Midtown Manhattan, and he wants bodies in it. I mean,
you don't really want to write that down to 30% of value. That would make me depressed too.
Right. But you know, and I get people to ask me that all the time. You know, you always say single-handedly, you know, just because Goldman forces everybody back in the office or Diamond forces everybody back in the office is not going to revalue real estate. He's not going to get the headquarters of P&G in Cincinnati to go, oh, well, they're all back in the office at JP Morgan's tower in Midtown. We got to get everybody here in Cincinnati back to the office 5 days a week. It's irrelevant to P&G what JP Morgan decides to do with their workforce.
So, you know, I sometimes think about the collateral damage associated with these big valuation shifts. And when I say collateral, it's a pun, because I really mean as collateral. Well, this real estate is the collateral for a huge volume of bonds. And we've got CMBS, we've got all sorts of things, insurance companies. This is an asset for them, endowments and real estate related lending. If we mark this stuff down by 30 cents on the dollar, a lot of people are going to get hurt.
Yep.
Does this not concern you? Where does this lead?
Oh, no. This definitely concerns me. And the way you said it is correct. If we mark it down to 30 cents on the dollar, because we've been holding it at par, pretending that it doesn't exist, and then we have this much markdown all at once, as opposed to saying that it's not working out, it's getting worse, and kind of slowly go there, would be a very different thing. Look, when I say that the economy's in no landing, and I said, you know, look, healthcare and energy are doing okay, the real estate market is definitely, because of its interest rate sensitivity and the lifestyle changes that we've seen, is definitely at risk. It is. And, you know, at any time you're talking about a $30 trillion economy, which is what the U.S. economy is, there's going to be multi-trillion-dollar sectors of it that are going to be struggling. And there's going to be multi-trillion-dollar sectors of it that are going to be doing better. So yeah, I do worry about the collateral being marked down. And I do worry about that largely because, let me come back to my theme. Mm-hmm. What industry is pushing harder than anyone else? The phrase they use is 5-0, to get everybody back in the office 5 days a week. It's financial services. What industry is the least able to understand the cultural shift and the work from home shift? Financial services. So what industry is most likely to mismark their asset values because they don't get it? Is financial services.
And what industry is long of a whole load of fixed income as well?
Financial services. And that's why I worry, I do worry about that. Now, is that enough of a reason to say the Fed's got to stop raising rates and maybe cut rates? No, because they can make it worse, because if all they're going to do is foster demand and push inflation even higher, it could have even more deleterious effects on the economy. But I do think that Diamond and Goldman would behoove of, you know, the world's at 3 days a week. Maybe our workforce should be at 3 days a week so that they understand how the rest of the world is operating. And but they don't want to do it that way. So yeah, I get it. I get it that, you know, the collateral is a problem, and I agree with you, it is. But it isn't enough of a problem to say, therefore, stop with the rate hikes, cut rates, and, you know, and change policy. At least not yet.
Yeah, it's not clear to me that solves anything. Mm-hmm. Eventually you might have to recognize that loss, and I can see why you don't want to do it now, but it's, you know, it doesn't necessarily make the Fed stop rate hikes. On this bond market, is it going to continue selling off? Can it continue selling off like this? Yeah,
you know, I've been of the opinion, as I said, look, you know, I think a lot of this movement has been going from neutral keeps moving up as much as interest rates, and that's why we're not nearly as restrictive. I also think that there is a concern that we are in a higher inflation environment. And the way I've argued what's been going on with the bond market is if the Fed wants to make more noise about that they're almost done raising rates, or maybe they are done raising rates, or there's one more to go, And we're concerned that we're in a 3% interest rate in world. If you're not going to fight inflation, I don't want to own your bonds.
Yeah.
And that might be really what's happening. Because let's put this into perspective. If we're in a 3% inflation world, the Fed thinks that the real rate, R star, is 50 basis points, which means what is the neutral funds rate? It's 0.5% above the real rate. Well, earlier I said if you go back far enough, real rates, when you have a concern about inflation, can average 2 or 3. That could mean then potentially that neutral on the funds rate might be closer to 5, maybe 4.5 or 5. Now we're 5.25, so we're a little bit restrictive. But if the Fed is going to say, that's it, we're just going to get slightly above neutral and we're done, and we're going to start mumbling higher for longer, the market might think that's not going to be enough in order to stop the inflation concern, and we're going to see inflation continue to stay up. I don't want to own your bonds. I think that that's really what, in my mind, is what's driving this push out of duration. And that if you want people to come back to duration, start with this idea that the inflation rate is not going to be a problem, so that nominal growth, you could start ratcheting down your expectations on. Nominal is inflation plus real. Problem Wall Street also has, I think, is that for 30 years before 2020, we just assumed inflation was 2. There. I spent 3 seconds on the subject, I'm done. And we spend 99% of our time talking about all of the components of real growth, housing and consumers and everything else. But now I think in this world we got to say, we got to spend half our time figuring out what's going on with inflation and half our time figuring out what's going on with real growth. And we're not spending enough time with inflation. We just mumble, used cars are going to come down, or airline tickets have peaked, therefore the problem's solved. It's a little bit more complicated than that. And if we don't see that inflation rate come down and nominal growth come down, interest rates aren't going to come down.
The two things that tell me you're probably right, one of which is the UAW strike. They didn't want the real wage cut. They're pushing back. And they're not the only guys who are going to push back. Anyone who has any market power will push back. So we used to call that, back when I was younger and trading bonds, second round effects in Europe.
Yeah.
This looks like second round effects to me. The other thing is crude oil. If you had a recession brewing, crude oil would not be here.
Right. So on your first part, there's another joke too, is that the day we're recording, September 28th, the 10-year yield is up 20 basis points in 48 hours. What happened 48 hours ago was the first time in American history a president of the United States stood on a picket line with a bullhorn. And they're like, well, if he's already picked a side with labor, then maybe I need to reprice the bond market for a higher wage inflation reality. But to your other point, you're right, crude oil. If you look at crude oil prices in general, we all like to think that they're supply driven, and they are. I mean, I'm not suggesting that they're not. And yes, OPEC plus, the Russians and the Saudis have cut back on production, and everybody points to that. See, that's why prices are going up. But they're also a metric of demand. Now, Bloomberg has an interesting series that they do, which is called implied demand of crude oil. How much did the U.S., it is a U.S. production number, how much did the U.S. produce this month, plus what did we import, netted against the change in inventory. What you have left over that's what we consume that week. So that's the implied demand. The implied demand numbers are over 20 million barrels a day now, which is an all-time high. What does that tell me? No landing. That tells me the economy is, when your economy is going, you consume energy. When your economy is not going, you don't consume energy. And so we are consuming energy big time because our economy is going. And so part of what's going on with crude oil is, the political aspects of it. People want to say it's all the Russians and the Saudis' fault. And there is something to that. It's not that's not meaningful. It is. But there is a strong demand component that has been pushing this. Now we're in the seasonal blend, where we're going from the summer to the winter seasonal blends in gasoline, and we're seeing the gasoline prices kind of plateau like they do every September, October. Yeah. But I think that once we get past that, we're going to see gasoline prices start moving up as well too.
I think I see evidence that diesel prices are going to squeeze globally, and that's a big input on inflation as well. Everything you get pretty much got moved to you via diesel. So there's a lot of reasons to think inflation isn't coming down.
Energy goes into transport costs, it goes into manufacturing costs, it goes into some of the production costs. Where do you think plastics come from, or asphalt for that fact too? Those prices are going to go up as well. So you're going to get, an assessment on your real estate taxes because asphalt prices went up when they repaved your road. So it filters through in a lot more than just the price at the pump. The price at the pump is just the emotional thing that we see with it.
I think we're pretty much out of time. Is there anything else you wanted to raise that I didn't touch on, or what have I missed? What should I have asked you about?
The only other thing I'll raise in 2 minutes is if you look at the stock market, and a lot of people have raised this, the Magnificent Seven are roaring ahead. If you take them out and you look at the S&P 493, it's up less than 1% for the year. If you look at the Russell 2000, it's unchanged on the year. The vast majority of the stock market is still struggling except for those 7 stocks.
Yeah.
Why is that? I do think it is part of this restructuring or repositioning of the cycle that TINA exists. There is an alternative, and the alternative is a 5.5% money market rate.
I know, I've got T-bills.
Right, because what the University of Chicago Center for Securities Prices, for Research and Securities Prices has said over long periods of time the stock market returned 9%. Okay, I can get over half of that with no risk in a money market fund or buying a 6-month T-bill. That's different than 2019 when if I wanted to be out of the market I got nothing. And so now that competition is there, and those companies are going to have to meet that competition, and those companies are paying up to keep their workers too. So you're starting to see this cycle shift in everything but those gigantic mega cap tech stocks that are all tied to the word AI. So this cycle, I think, is showing up in risk markets.
Yeah.
It's just that, the S&P's up 12% for the year. It's a good year. Yeah, well, 9 of that or 10 of that is 7 stocks. And the S&P is actually up more like 10.5% for the year now. But 9 or 10 of that is 7 stocks. The other 493 stocks have collectively raised the index maybe 1%. And if you were in a T-bill through January 1st through today, you've gotten 3.6%.
And you slept just fine.
Yeah, exactly. So I do think that the stock market, if you peel back those 7 stocks, this cycle change, higher wage costs, higher input costs, higher competition is definitely showing up in the way that the market changed.
And if there isn't a landing, you haven't got any reinvestment risk either.
Right.
So yeah, I think that's a strong argument. Jim, I think we're out of time. Thank you so much for joining me, and thank you for participating and talking about all this stuff. It was great. Really appreciate it.
It was fun. I'm glad you invited me. Thank you.